Hi, my name is Dana Golden. Today we're going to continue our introduction to fundamentals of derivatives by a look at options. So financial option is a contract giving the buyer the right but not the obligation to buy or sell an option asset. There are two main types of options. There's a call option, which is the right to buy, and there's a put option, which is a right to sell. And the strike price is the agreed upon price to exercise the option at the expiration date, which is the last date at which you can exercise the option. So there's a fundamental relationship between a European call and put option, European call option, a specific type of call option as the one we normally think about on the same underlying option asset. So the call price minus the put price, the price at which you have the right to sell minus the price at which you have the right to buy is equal to the spot price of the asset minus the strike price raised to times E raised to the risk-free rate times the time to expiration. And this put call parity helps ensure the option is correctly priced to ensure no arbitrage opportunities. Here it is visualized. So blue is the underlying price of a long call and the profit and loss. So it increases as the underlying price increases. Because it's in the money. So the option price, as the price of the asset increases, your option is more likely to be in the money. And then short puts, as the underlying price increases, the put option its cost also increases here, and they have this fundamental relationship, and then so this represents put call parity. Then you have implied volatility, which is the market's forecasting of underlying assets volatility. This is derived from options prices using models like Black-Scholes, and this reflects market sentiment. So high implied volatility means that there's market considers it to be greater uncertainty, and low implied volatility means there's lesser uncertainty. So in last lecture, we talked a lot about the futures price was the average price of a good. Implied volatility is a statement about how much movement and how much uncertainty is in that average. So valuing options, one framework you can do this with is the Binomial Asset Pricing Framework, which evaluates option prices by simulating possible paths the underlying asset's price can take. This assumes the asset price can either move up or down discrete time steps, risk-neutral valuation to discount expected payoff. So we're trying to value it correctly, which means that we're trying to see what the asset is worth. And the way we're doing that is we're assuming that it can go up with some probability, down with some probability. And if it does go down, we assume that that leads to this price, and if it goes up, we assume that leads to this price and leads to this amount of profit. So you can solve the risk neutral probability by taking the exponential raised to the risk-free rate times the time delta minus the down factor divided by the up factor minus the down factor, which is the risk of up and down. And then you have the option price, which is the price of the option. The price of a call option is equal to this factor right here times the price of the call if the option price goes up times the 1 plus 1 minus the probability, or sorry, times the probability of the option price going up times the value of the call option if it goes up, plus 1 minus the probability of the option price going up, which is the probability of the option going down and essentially being worthless because this is a call option, times the price of the option going down, or the value of the option goes down, which is pretty much 0. So this is Binomial Asset Pricing Model, or the BAPM. So you have some probability that these prices are going to go down. You have some value if those prices do go down. Here P is price, not probability. So if the price of the option goes up, here it's a put option. So you want to sell it, and you'd like to sell it at a higher price that's currently trading at. If it's a call option, you like to buy it at a lower price than it's currently trading at. So if it goes up, eventually it's very unlikely that it will go back down, and so the price of the option is 0. So the price of the option goes to 0 as the option goes further and further out of the money, and as the price of the asset goes down and down, the ability to sell the asset at a higher price goes up and up, because you can buy the asset at a low price and then sell the asset at a higher price, and so the option becomes more and more valuable as the price goes down. And depending on which direction these take, the asset will have different prices. And so normally the way you do the Binomial Asset Pricing Model is you have a probability of each of these. You'd assume the probability is independent. It kind of has to be because you add these up to 1. And then you multiply these probabilities to get this end track. And then, or not, they're not independent, they're mutually exclusive, rather. I should say they're mutually exclusive because they add up to 1. But the independence is what's going on here makes this possible. But yeah, so just think about mutually exclusive. Think about it as mutually exclusive, and so you have some probability this ends up here, and you have a probability this ends up here. This times this times this. You have a probability that ends up here. That's this times this times this. You have a probability that ends up here, which is the probability that gets here. And then you take that probability, you multiply by the price at all of these different eventualities, and then you solve for the option price by adding those together, which get the expected value of the option at date of maturity. So consider a call option with a current stock price of $50, a strike price of $52. So if the price is greater than $52, you can buy at a lower price than the current price, and so the option is in the money if the price is greater than $52. The risk-free interest rate is 5% per year. Time to expiration is 1 year, and once time step is 1 year. The up factor is 1.2, down factor is 0.8. So the risk-neutral probability is calculated this way: e to the 0.05. We have the risk-free rate times 1 minus the down factor divided by the up factor minus the down factor. The down factor is how much less it's worth if you have it go down. The up factor is how much more it's worth if you go up. So risk-neutral probability ends up being 0.627. And then you compute the asset price at maturity, and you end up with 40. So here you have the price at time u, the price of the stock at time u, or the price of the commodity in this case, equals the original price plus the up factor times the up factor, which is 50 times 1.2. This is how much it's valuable if it goes up, how much you expect it to potentially go up, rather, equals 60. And the price of the stock goes down equals the price of the stock if at time 0 times the down factor equals 50 times 0.88 equals 40. And if you want to calculate the option payoff at maturity, you take the max of the expected price up minus minus the strike price. So you're able to buy at $52, and you're in the money. You're making money if the stock price is greater than that price. So if it's 60 minus 52, it's 8. So it's worth 8 at maturity. If it goes up, it's worth 0 if it goes down, because now there's no value in being able to buy it for less, because you can do that on the open market. And so then you discount the effective payoff to today using this formula here we talked about earlier. You have a probability of it going up, the risk-neutral probability going up. You have the risk-neutral probability go down. You have the value goes down, which in this case is 0, because the call option is worthless if it's worse, if the value of the asset is below the strike price. And then you get that this term goes away. This term goes to this, because you're multiplying this by this, and you're multiplying that by that, and then you get, you're solving for this, and you're multiplying this together, and you get 4.77, which is the price of the option. Let's review what we did. We started by calculating the risk-neutral probability using the up factor and the down factor and the risk-free rate. Then we computed the asset price at maturity in both the option which the price goes down and the price goes up. So we assume that the price might go up this much, so your price might go down this much. So that's what's called the binomial pricing options pricing models, because we're making asset pricing models because we're making some assumptions as to what happens in two different scenarios, and then we calculate the option payouts to maturity, and then we use this to discount and expected payouts today to solve for the option price. So now I'm not going to test you on what I'm going to talk about now, which is Brownian motion and Black-Scholes. So actually, I'm going to put in a special video, and then after I finish up Black-Scholes, everything will be on the test again. Thank you, and have a great day.